Welcome. In this video, XCN versus NEAR. Which is better? Can XCN increase by 500%? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
But first, let's analyze XCN. Fibonacci retracement levels, one of the tools used in technical analysis in cryptocurrency or financial markets in general, are highly effective in calculating the likelihood of price reversals at certain levels. This analytical method is used to predict potential future support and resistance levels based on historical price movements. In this context, a Fibonacci retracement drawn from a low to a high is particularly valuable for identifying key pullback zones for investors. Two key levels that deserve special attention are the 61.8% or 0.618 and 78.6% or 0.786% retracement levels. These are generally considered zones where the price might begin to recover after a correction. These levels have historically worked across countless financial instruments and are seriously taken into account by the majority of investors. Since Fibonacci ratios reflect a natural and mathematical order, they also tend to align well with market psychology. Reactions from these levels often indicate that buyers are stepping back in and the price may be turning upward. After a strong upward movement from a bottom, an asset naturally enters a correction phase. This correction is also important for the health of the uptrend as it allows the market to rebalance. The depth of this correction is usually measured with Fibonacci retracement levels. This is where the 0.618 and 0.786 levels come into play. Price tends to pause in this range, selling pressure slows down, and buyers start to re-engage. For this reason, these levels are referred to as reversal zones and hold great importance for investors. Especially when volume increases or momentum rises as the price approaches these levels, it can be considered a reversal signal. In other words, when the price hits critical support levels like 0.618 or 0.786 and reacts upward, it's a structure that has worked time and again in the past. Thus, these zones serve not only as technical levels but also as psychological barriers. Order activity increases in these areas, buy orders accumulate, and more often than not, a new wave of upward movement begins from these zones. For example, after a price surge to a peak, a correction might follow. During this pullback phase, investors use the Fibonacci tool to measure from the bottom to the top. If it turns out that the price has reached the 0.618 or 0.786 retracement levels, those areas are evaluated as critical reversal zones. This implies that the previous upward move has been corrected by approximately 61.8% or 78.6%. A correction of this depth is usually enough to fuel a renewed upward movement. Still, as always, these levels do not guarantee a reversal, rather they are considered zones where a reversal is more likely. That means reactions from these areas may present opportunities, but risk management measures like stop losses should also be in place, because sometimes price breaks below these levels, leading to deeper corrections. However, based on past data and the principles of technical analysis, these levels can be considered significant support areas. Similar patterns have been observed in past examples. In many charts using Fibonacci retracement from the bottom to the top, price often gives a strong reaction from the 0.618 or 0.786 levels, and sometimes those upward moves even break previous highs. This repeatedly shows just how effective these zones can be. It's also commonly observed that investors tend to make heavy buys in these zones, causing prices to quickly rebound once they reach them. In some cases, prices may resume upward momentum without reaching these levels, but the most reliable reversals often start from these areas, because when price reaches these zones, it attracts investor interest and ignites buying appetite. These points are also seen as liquidity pools. When price enters these areas, stop-loss triggers or new buy orders can result in sharp movements. Furthermore, these ratios have mathematical significance in the natural structure of Fibonacci itself. The 0.618 ratio, known as the golden ratio, appears in many natural phenomena, from leaf arrangements in plants to proportions of the human body, DNA spirals, and even the structure of galaxies. This directly reflects the Fibonacci number sequence, and this natural order also manifests in the markets. This explains the psychological and mathematical basis for why Fibonacci levels often work so well in technical analysis. In this context, when a price pullback moves towards the 0.618 and 0.786 levels, investors should closely monitor these zones and evaluate potential reversal signals. As with any analysis, it's better not to rely solely on Fibonacci levels, but to confirm them with additional indicators for more accurate outcomes. In conclusion, the 0.618 and 0.786 levels in a Fibonacci retracement drawn from bottom to the top are among the strongest reversal zones in technical analysis. Reactions from these levels may indicate the resumption of an uptrend. However, patience is key. Observing how the market reacts to these levels and positioning strategically is of great importance, because movements starting from these zones often mark the beginning of long-term trends. Therefore, investors should take these levels seriously both technically and psychologically. Truly experienced traders can seize the opportunities that form in these areas and potentially earn significant profits. This once again demonstrates the strength and importance of Fibonacci retracement levels in the markets, but we can't make decisions based solely on Fibonacci.
Let's take a look at other metrics as well. Stay tuned. I'm interrupting the video for a moment, friends, because BitTunics Exchange has a great campaign. Here's how it works. After registering on the exchange via the link in the description and completing KYC, if you deposit $100 for your first deposit, you will receive a $20 bonus. If you deposit $500, you'll receive a $100 bonus, and if you deposit $1,000, you will receive a $200 bonus. I think this is an excellent opportunity for leverage trading. For more details, you can read the articles below. The link is in the description.
Sudden and sharp pullbacks occasionally observed in the market often appear, from a technical standpoint, as merely part of short-term corrections. A similar situation seems to have occurred in the most recent price movement. While the asset had been trading upward for a certain period, it unexpectedly and rapidly dipped downward. Such movements can shake investor sentiment in the short term. However, similar examples from the past show us that following these types of steep drops, the market often stages a recovery just as strong or even stronger. Looking at the volume analysis, the significant increase in selling volume during this drop suggests that panic selling was at play. However, when examining the recovery process that followed, it's clear that buyers became active again as soon as the price reached a certain support level, giving a strong reaction. This indicates that support levels still hold relevance and that investors view these areas as valuable opportunities. Additionally, the area to which the price fell has historically acted as a solid support zone, having been tested multiple times in the past. This region has previously served as a turning point where strong buying pressure emerged. These types of zones can also be referred to as liquidity areas or institutional buying zones in technical analysis. When price reaches these levels, sharp increases may be observed due to the involvement of large investors. When examining past market structures, it's evident that this asset has previously experienced sharp upward spikes following sudden pullbacks. In this context, the current situation aligns closely with historical patterns. Notably, there are historical data points showing that after such drops, the asset has experienced increases of over 100%. Therefore, based on technical analysis, the current decline may simply be a temporary correction and could offer significant opportunities for investors. Another factor that strengthens this scenario is the overall market momentum. As long as there hasn't been a clear break in the trend direction, the declines appear to be only short-term corrections. The price structure is still forming higher lows and higher highs. As long as this structure remains intact, the prevailing trend is upward, and these sharp drops can be viewed as part of a broader bullish correction. In addition, when analyzing the volume profile, there is evident demand at the levels where the price declined, indicating that substantial buying has occurred in this zone. This suggests that institutional investors or large capital holders may find these price levels valuable and are potentially opening positions. This increases the likelihood of a strong upward move from the current level. Although sharp pullbacks can be emotionally challenging for investors, from a technical analysis perspective, these types of moves often serve as precursors to larger and stronger rallies. Technically, these levels are often associated with stop hunts or shakeouts, where the market clears out stop-loss levels of retail investors before continuing in its intended direction. Currently, the probability of such a manipulation scenario appears quite strong. From a market psychology perspective, these sharp drops typically create a climate of fear. However, savvy investors tend to turn this fear into opportunity. The principle of buy when there's blood in the streets is one of the most well-known mottos in the investment world. According to this principle, purchases made during panic moments often result in the most profitable trades. A similar situation may be unfolding now, as most investors are selling out of fear, while smart investors could be preparing to expand their positions at these levels. To summarize, despite the sudden and sharp price drop, it's important to remember that in technical analysis, such movements are often just temporary corrections and can be followed by major upward moves. The current decline may also signal a significant opportunity. When technical indicators, support levels, historical price behavior, and volume data are all evaluated together, they provide strong signals that a much larger rally could follow this drop. At this point, it is crucial for investors to carefully analyze the situation and shape their strategies based on technical data. If the upward trend resumes, it should also be noted that the price may have the potential to retest and even surpass previous highs.
Comparing projects in the cryptocurrency market, both from a technical and fundamental analysis perspective, is extremely important. These comparisons can help investors identify high-potential projects at an early stage. In this context, when comparing XCN with NEAR protocol, it is possible to observe significant differences and similarities between the two. When analyzing their visions, infrastructures, and market performances, it can be argued that XCN has the potential to become a major project like NEAR in the future. However, this possibility depends on numerous technical and strategic developments. First of all, NEAR protocol is currently far ahead in terms of market capitalization, adoption rate, and developer community. NEAR increases scalability through sharding technology and offers a user-friendly interface and developer experience. Additionally, it is supported by the NEAR Foundation and hosts a robust ecosystem with significant projects in Web3 fields such as DeFi, NFT, and DAO. Therefore, reaching NEAR's current level is not easy for any project. For XCN to reach that level, it requires not only technological capability, but also strong community support, large-scale partnerships, and continuous development. That said, XCN also has some important advantages that should not be overlooked. XCN is a project built on a Layer 1 blockchain infrastructure which enables high performance and low-cost transactions. Layer 1 projects generally offer greater flexibility and independence. This allows various types of decentralized applications to run more efficiently on-chain. From this perspective, it should be noted that XCN may offer some technically more innovative solutions compared to NEAR. When looking at XCN's price potential, its current market capitalization is significantly lower than NEAR's. This could present a major growth opportunity for investors. If XCN manages to reach NEAR's market cap, we could see a price increase of around 500%. However, this potential increase is purely theoretical and not guaranteed. In the crypto market, such a significant rise depends not only on technical indicators, but also on market sentiment, macroeconomic conditions, regulatory news, on-chain activity, and community support. Of course, XCN still has a long way to go to grow as much as a project like NEAR. Currently, XCN lags behind NEAR in terms of adoption rate, developer community, and ecosystem diversity. However, this does not mean XCN is a failure. On the contrary, projects at this stage can offer higher returns for investors due to their potential growth. Especially for early-stage investors, such projects can yield significant profits. But because high return potential also means high risk, caution is essential. XCN's Layer 1 blockchain infrastructure makes it more than just a token. It is also a platform where different types of applications can be built. This means XCN has the potential to host new projects in DeFi, NFT, or DAO sectors in the future. If this potential is utilized correctly, XCN could eventually reach a much larger user base and significantly increase its transaction volume. At this point, the vision of XCN's technical team, its roadmap, and the partnerships it establishes will play a critical role. At its current stage, it's clear that XCN is still at the beginning of its journey and has many milestones to achieve. However, this long journey, if approached with the right strategies, could take XCN to a much different position in the future. Especially as competition among Layer 1 projects increases and users demand higher speed and lower fees, interest in projects like XCN could grow. This could eventually lead to XCN gaining value and attracting new investors. To achieve long-term success, XCN needs to build a strong community and expand its developer ecosystem. Additionally, offering support and incentives for decentralized applications can increase on-chain transaction volume and create a more solid foundation. If XCN successfully implements these strategies, reaching a market cap similar to NEAR may no longer be just a dream. In conclusion, when comparing XCN with NEAR, it can be said that XCN is currently behind NEAR, but theoretically has the potential for up to 500% price growth if it reaches NEAR's level. However, this potential increase depends on significant strategic developments, strengthening the technological infrastructure, and expanding the user base. The strength of XCN's Layer 1 technology is a major advantage in this journey. Therefore, from a long-term perspective, it's clear that XCN has important opportunities ahead, though reaching them will not be easy.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I'll be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.